The FTSE 100 surged 2% on Wednesday as oil slipped below $100 a barrel. The same morning, UK gilt yields hit a 28-year high, a market celebrating a peace signal, while sovereign borrowing costs scream stagflation. Those two facts cannot both be right at the same time. The rally traces directly to a single Trump social media post. He announced that Project Freedom, the U.S. military escort of ships through the Strait of Hormuz, would pause pending a peace deal with Iran. Brent crude pulled back sharply on the news, and FTSE 100 energy-sensitive names immediately rebounded. The mechanism is straightforward. Hormuz carries roughly a fifth of global oil supply, and any signal that it reopens drains the geopolitical risk premium from Brent. But the word paused is doing significant work here. Trump added that bombing would resume if Iran failed to agree terms. Iranian media described the move as a retreat, while Tehran's surviving leadership was in Beijing for talks, not at a signing table. The strait remains technically closed. Jet fuel has doubled in price since the war began. Goldman Sachs analysts have described UK supply as critically low, and airlines have already cancelled 13,000 flights in May alone. IAG, the parent of British Airways, confirmed it is raising fares because fuel costs have risen sharply. The peace signal lifted equities. The underlying supply chain did not move. The gap between the FTSE's relief and the physical oil market's reality sets up the stress point that matters most for UK portfolios right now. Not in energy stocks, but inside the banks that sit at the center of the FTSE 100.
The FTSE 100's Big Five banks reported first-quarter profits of £15.6 billion combined, a figure that beat consensus. That is the number most headlines used. The number most headlines skipped. The sector absorbed a $2.5 billion shock in the same quarter. The mechanism runs in two directions at once. Higher oil prices keep inflation sticky, which forces the Bank of England to hold rates at 3.75%, or raise them further. Higher rates expand net interest margins for Lloyds, NatWest, and HSBC, which is why Lloyds now forecasts the BOE will not cut until the third quarter of 2027. That forecast is simultaneously a profit upgrade and a warning about the economy the bank is lending into. The counterforce is loan quality. The Big Five set aside over £600 million specifically for Iran war-related credit deterioration in Q1. Barclays trimmed its 2026 UK growth forecast to flat, 1.1%, down from 1.1%. NatWest's own inflation model moved up to 3.5%. The bank's CEO said the duration of the energy shock is the single variable that determines whether resilience holds. That is not a comfortable statement from a lender with significant UK retail exposure. A second stress arrived from outside the Iran chain entirely. Barclays absorbed a £228 million hit from the collapse of specialist lender MFS. HSBC took a $400 million charge from a fraud-linked private credit exposure, also reportedly connected to MFS. Both banks are now reporting under a tightened Pillar 3 regime that for the first time requires explicit disclosure of non-bank financial institution exposure. The regime change is not a cause of the losses, but it means the next MFS-type event will be visible faster, which compresses the time banks have to manage it quietly. HSBC missed consensus and was the only Big Five member to do so. Its finance director called the private credit exposure idiosyncratic. At $6 billion against a $1 trillion balance sheet, that framing is defensible. But idiosyncratic events are not always one-offs. The same MFS collapse hit two separate banks in the same quarter.
The Bank of England holds rates tomorrow at 3.75%, but the market is no longer reading that as neutral. Gilt yields reaching a 28-year high is not a rate decision problem. It is a fiscal credibility problem layered on top of a rate decision problem. UK 30-year gilt yields hit their highest level since 1998 this week. Bond markets reacted to two simultaneous signals: oil-driven inflation making rate cuts politically untenable, and fears about Labour's fiscal direction after local election results suggested the government faces a significant loss of seats. The ghost of the 2022 Truss mini-budget is explicitly being cited by traders. Mortgage rates did fall marginally. The average two-year fix dropped 4 basis points to 5.83%, but the direction of gilt yields points the other way. Homeowners facing renewal are staring at analysis suggesting annual mortgage costs could rise by £3,000. The leaning here is asymmetric, but not one-directional. If the U.S.-Iran peace talks produce a signed agreement and Brent crude falls sustainably below $90, the inflation argument for holding rates dissolves. The Bank of England could cut sooner than Lloyds projects, gilt yields would compress, and the banking sector's loan quality stress would ease before it becomes a genuine impairment cycle. That path still exists. The path that currently has more weight. The Trump post was conditional language. Iranian leadership is not signaling acceptance, and Goldman Sachs flagged jet fuel supply as critically low regardless of the current Brent price. If oil stabilizes in the $100 to $115 range, which is where it has spent most of the last 6 weeks, the Bank of England faces a stagflation scenario where cutting risks inflaming inflation and holding risks accelerating the job slowdown NatWest is already flagging. The verification benchmark is Brent crude's closing level over the next 3 sessions. If it holds below $95 on confirmed progress toward a signed Iran deal, the FTSE rally has a real floor and banks' loan quality outlook stabilizes. If it rebounds above $105 on stall talks, the 28-year gilt yield high is not a spike, it is the new baseline. The FTSE's 2% relief move was real. Whether it was earned is the question that crude oil will answer first. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.